Welcome to the Daily Drawdown, your fast brief on rates, risk, and where pressure is building. The biggest story right now is that a lot of things still look fine on the surface while the plumbing underneath gets more fragile. That shows up in treasuries, AI financing, leveraged products, and even global shipping. September still looks finely balanced, and the main point is that the Fed is not going to swing on one jobs print alone. What matters more here is the inflation path, inflation expectations, and market break-evens, because if those stay hot, the Fed has less room to wait. The other issue is credibility. Repeated presidential pressure and reported contact with incoming chair Kevin Warsh are raising concern that Fed independence could look compromised even if policy itself does not immediately change. Markets can price that perception fast. If investors think the White House is leaning on the Fed, long-term yields can rise simply to compensate for that risk, and that means higher borrowing costs across the economy. What to watch next is whether the Fed tries to tighten through balance sheet policy and communication first instead of reaching for an immediate rate hike. But if financial conditions keep tightening and inflation stays above target, at some point talk is not enough. The long end of the Treasury market is where stress is accumulating. Heavy Treasury issuance, foreign exchange strain, and huge AI-related corporate borrowing are all pushing on long-term yields. Markets are functioning, but functioning is not the same as healthy. A 30-year Treasury yield near 5% is being treated as a real line in the sand. Some models suggest that move alone could shave about 5% off the S&P 500. Recent coordinated calming moves from Treasury and the Bank of Japan helped, but they also confirmed that officials are watching this closely. The practical takeaway is simple. If long yields keep rising on their own, the Fed may be forced to respond even if it would rather sit still. At the same time, leverage across markets still looks uncomfortably high, both in plain sight and in the shadows. Jamie Dimon and others are warning about exposure running through prime brokers, hedge funds, ETFs, and tail risk derivatives. The danger is not everyday volatility. The danger is one large, forced unwind hitting a market that is already thin. Recent blowups, including a roughly $45 billion hedge fund failure and collapses in leveraged memory trades, look more like an anti-leverage reset than a full cleansing. There is still about $8.3 trillion sitting in money market funds, so cash exists, but concentrated risks do too. This matters more because the ETF universe now tops roughly 5,000 funds, with around 6 new launches a day this year. ETFs improve access and liquidity in normal conditions, but leveraged ETFs add derivatives, counterparty exposure, and path-dependent risk that many investors still underestimate. The AI trade is still alive, but the bottlenecks are shifting. This is no longer just about who can fab the most chips. The pressure point is increasingly at the system level, especially high bandwidth memory and the rest of the stack needed to make whole clusters work. NVIDIA reportedly considering less memory per Rubin Ultra die to stay on schedule tells you where the constraint is moving. And the bigger issue is deployment. Replacing a single rack can cost around $8 million, and major hyperscale facilities can run 15,000 to 20,000 racks. That means shortages in memory or networking gear do not just raise prices, they can delay actual AI capacity coming online. On top of that, hyperscalers are financing CapEx at a scale the bond market has to absorb. Alphabet alone sought up to $25 billion in new debt, on top of massive existing cash and prior bond issuance, with reported order interest near $100 billion. That kind of supply can crowd investors, widen spreads versus treasuries, and create a liquidity squeeze if issuance keeps accelerating. So the near-term macro risk is not that AI spending disappears, it is that AI capex slows because rates, financing conditions, permitting, power, water, or local opposition start to bite all at once. If the blank check phase ends, chip and infrastructure suppliers that have been riding hyperscaler demand are the most exposed. The demand side of AI still looks real in the enterprise. AI agents are increasingly being treated like a baseline business capability rather than an experiment, especially when they can run on-prem or in private environments for sensitive data. Companies are reporting tangible gains. Airbnb says AI cut development time by as much as 60% and lifted shipped features around 80% while holding headcount flat. Others, including Block, Unity, and Chime, are also pointing to faster product delivery and better revenue or margin outcomes. But labor market data show the other side of that efficiency. Hiring has become less efficient, with the posting-to-hire ratio deteriorating from about 2 postings per hire before ChatGPT to roughly 5 by July 2026. AI-exposed junior roles have taken a bigger hit, and the premium for basic AI skills is fading because AI fluency is becoming table stakes. In equities, one clear message from this cycle is that investors are paying for perfection and punishing anything less. Memory names like SanDisk, Western Digital, and Micron have posted record revenues and still sold off when margin guidance or forward commentary disappointed. The market is already assuming peak-level execution, even as analysts expect memory margins to normalize from extreme highs. The same pattern is showing up more broadly in earnings season. Results have been strong across many sectors, and beats are still common, but weak guidance is getting hit hard. That is why credibility matters so much right now. Companies that surprise investors with sudden cuts, instead of signaling deterioration early, are taking disproportionate damage. 2 supply chain pressure points are worth keeping in view because they feed directly into inflation and industrial costs. First is shipping. Risk is concentrated around 3 choke points: the Strait of Hormuz, the Red Sea and Bab el-Mandeb, and the Panama Canal. Panama is especially important because traffic is up, LNG and fuel product transits have jumped sharply, and auction prices for large lock slots have surged from around $100,000 in normal times to multi-million-dollar levels. When ships get pushed around the Cape of Good Hope, you add more than 3 weeks to voyages, and that feeds cost, inventory, and timing problems back into global trade. Second is critical minerals. Copper has hit record highs as data center demand and electrification collide with supply and policy risk, including reported export restrictions out of the DRC on copper and cobalt concentrates. For manufacturers, that means regional sourcing and supply security matter more, and imported inputs are getting structurally more expensive. The next market tests are straightforward. Watch long-dated Treasury yields, especially any move toward 5% on the 30-year. Watch inflation expectations more than one noisy labor print. Watch whether AI debt issuance starts to pressure credit spreads. And watch for any sign hyperscaler CapEx gets delayed by financing or infrastructure constraints rather than demand. If those pressures ease, risk assets can keep grinding. If they compound at the same time, the market will care very quickly about fragility that it has mostly been willing to ignore. That's the brief for today. You've been listening to the Daily Drawdown. This episode was generated by Podkey. Create your own at podkey.fm.